hope you guys are doing well. It's Jordan Dove coming to you from the Dove and Associates studios in Las Vegas, Nevada. It's spring. It's starting to heat up. The flowers are starting to bloom. We love it. Today is March 13th, 2023. And boy, do we have some big news for you on the Market Pulse update. It's been a hectic week. It's been crazy. I hope you guys enjoyed today's episode. Our goal is to analyze the information and data and keep you informed on the economy and the real estate market so you can make better informed decisions. If you guys need help in the real estate market, you're looking at making moves, you're looking at obtaining some money in financing, reach out to me. My contact information is in the description. Love the opportunity to work together and come up with a solution for whatever your goals may be. All right, so let's get into the review of last week. Fed Chair Powell had a hawkish congressional testimony. We had the February jobs report and the FDIC's shutdown of Silicon Valley Bank to protect insured depositors. We saw stocks take a big hit last week. As of about an hour ago, the financial sector is taking a big hit in the market while the three major indices are staying positive thus far. And while SVB, it was the 16th largest banking institution in the United States with about $209 billion in assets under management. And it did have specialized lending practices, and the shutdown should only be a temporary shock to Wall Street. The $19.8 trillion U.S. banking system, it still remains very well capitalized. Biden came out today and said they're going to bail out the banks. They're going to bail out the businesses, and they're going to make sure that they get their money, whether through a loan or however they're going to do it. But we are going to see some form of a bailout. But I believe this is also going to give an opportunity for larger banks to absorb the smaller ones in what we would call fire sale. Might not be the healthiest move for consumers long term, but big banks are going to have a lot more power if this comes to fruition. So Powell told Congress that the Fed still has more work to do to cool the economy and inflation, but later we received February's weak 0.2% gain in hourly earnings and rising 3.6% unemployment rate to show that the Fed is making progress. However, it is moving much slower than anticipated. It's going to be really interesting to see what the government does with these banks. We've already seen another bank, Signature, shut down. We're reading reports that bank runs are happening and consumers are trying to pull out their cash in the banks. Anyways, last week ended with the Dow down 4.4%, the S&P down 4.5%, and the NASDAQ down 4.7%, just north of 11,000. Bond prices overall benefited from from flight to safety, although the UMBS 6% slipped 0.71 to $100.31. In Freddie Mac's primary market mortgage survey, the national average 30-year fixed mortgage rate edged up again, but this week it's looking like it's coming down as these bond yields are absolutely coming down extremely quickly. Actually, there's a 100 basis point dip in the 10-year since Wednesday, the largest ever, I think. We'll talk about that in a minute. Now let's get into our national housing market update. Home building data firm Zonda revealed that most home builders, saw a strong start to their year. Their new home pending sales index, which is called the PSI, reported a non-seasonally adjusted 4.3% uptick in demand in January. Fannie Mae's February Home Purchase Sentiment Index found that most consumers still think it's a good time to sell a home, and the share of those who say it's a good time to buy went up 5% from January. A panel of housing experts surveyed by Zillow and Pulsenomics believes home price growth will pick up again in 2024, hitting a 3.5% annual growth rate every year through 2027. And that's a reassuring prediction for people who are in the market to buy this year. The panel forecasts that prices will slide 1.6% in 2023. Growth over the following 4 years is expected to average 3.5%, which is equivalent to the long-term average, something that would be much more normal and stable in terms of growth in the housing sector. New home sales are expected to decline to near 2016 levels this year, although they have started off pretty hot this year. And sales of both new and existing family homes are expected to slide in 2023. Now, CoreLogic had a report that annual home price growth fell to 5.5% in January, which has slowed down for the ninth straight month. Their chief economist sees price declines modest, which are projected to top at 3% peak to trough. The top takeaways from the CoreLogic report is that U.S. home prices, including distressed sales, increased by 5.5% year over year in January 23 compared to January 22. On a month over month basis, home prices declined by 0.2% compared to December 22. In January, the annual appreciation of attached properties, 6.5%, which was 1.3 percentage points higher than that of detached properties of 5.2%. CoreLogic forecasts show annual U.S. home price gains slowing to 3.1% by January 2024. Miami, Florida, posted the highest year-over-year home price increases of the country's 20 largest metro areas in January at 17.3%, while Tampa, Florida, continued to rank second at 11.7%. Florida and Maine recorded the highest annual home price gains, 13.4% and 11.5%, respectively. South Carolina posted the third highest gain with a 10.7 year-over-year increase. 3 states and 1 district registered year-over-year price declines. That was Idaho, down 2.3%, Washington State down 2.2%, Montana down 0.6%, and Washington, D.C. down 0.1%. Let's talk about some economic notes. Really interesting what's going on here. Something broke, but the Fed is still expected to go through with rate hikes. Markets still expect the Fed to keep up its inflation fighting efforts despite high-profile bank failures that have rattled the financial system the last week. Traders on Monday assigned an 85% probability of a 25 basis point interest rate increase when the Federal Open Market Committee meeting meets March 21st, with a decision coming on the 22nd. Goldman Sachs was virtually the only bank when it said it expects the central bank to press pause on rate hikes next week. Now, we had our jobs report come out, and here's where the jobs are in February 2023. I will put a chart up here on the screen for you. Here's the 1 month net change from February. The biggest growth sector with 105,000 jobs created is leisure and hospitality, followed by healthcare and social assistance, retail, trade, government, professional and business services, and construction, creating an estimated 24,000 jobs. Mining and logging stayed flat, while these sectors posted a decrease. Financial activities, manufacturing, transportation and warehousing, and information. That came from CNBC's chart, and their source was the U.S. Bureau of Labor Statistics, and that data was published on the 10th of March. Now, the 2-year Treasury yield, you guys know we follow that in real estate because mortgage rates closely follow the 10-year Treasury bond yield. So it posted its biggest 3-day decline since the aftermath of the 1987 stock crash. So what happened was investors swarmed into U.S. government bonds Monday after the collapse of Silicon Valley Bank and subsequent government backstop of the banking system. The rush sent Treasury yields tumbling down the hill. The yield on a 2-year Treasury was last trading at 4.06. That's down 53 basis points. 1 basis point equals 1/100th of a percent, excuse me. Prices move inversely to yields. Now, the yield has fallen 100 basis points, or the 10-year yield has fallen 100 basis points, or a full percentage point since Wednesday, marking the largest 3-day decline since October 22nd, 1987, when the yield fell 117 basis points, which followed that crash of October 19th, which is my mom's birthday, 1987, but not the year. Known as Black Monday, in which the S&P plunged 20% for its worst one-day drop. This move was bigger than the 2-year yield slide of 63 basis points that took place in 3 days following the 9/11 attacks. And as earlier this morning, we had the 2-year sitting at 4.136, the 10 at 3.53, and the 30 at 3.652. Just going to touch really quickly on the Southern Nevada housing market. Our inventory is absolutely crumbling right now, with sales and accepted offers coming under contract. Our absorption rate has gone up the last 4 readings in a row. We're now at 39.41%, which is about a 2.54 months supply of inventory. That is a 638 basis point or 6.38% increase from our last reading on March 6, 2023. So really interesting what's happening. Median prices for single-family condos and townhomes are staying kind of flat. January to February was pretty flat. We're going to see what happens this month, but we may be reaching a bottom, especially with inventory decreasing and sales picking up, which is why our absorption rate is skyrocketing. The predictions that we have for this week, guys: home building, retail sales, and inflation. We're estimating that we are going to see an uptick in builder activity in February, with housing starts and building permits ahead for the month. Economists expect a slight increase in retail sales for February, a slight decrease when you don't count auto sales. I have some friends in the auto industry. Apparently, there was a ton of subprime loans on a lot of vehicles. We're going to watch that closely. I'm watching that. Very interesting sector. I guess they were giving loans out and 5, 6, 7 year notes on cars, and people are unable to afford them, having $1,000 car payment. Absolutely insane. Anyways, they also see inflation slowing in both the consumer price index, the CPI, and the wholesale PPI, producer price index, this week. So the Federal Reserve Watch, as what we were talking about earlier, we're forecasting Federal Reserve policy changes coming in the coming months. And despite Fed Chair Powell's hawkish testimony before Congress, the futures market has now shifted and sees only a 1/4 point rate hike at the next 2 FOMAC meetings and then no hike in June. They're saying that there's a 100% probability of that 25 basis point rate hike after the March 22nd meeting, and there's an 85% consensus that there will be another 1/4 point rate hike at the May 3rd FOMAC, and they're saying they will pause on June 14th, but we will keep you guys updated on that. Anyways, that's the economic and housing report for the week of March 13th, 2023. Really thank you guys for being here. Please like the video, leave a comment if you guys have any questions. I'd like to know where you guys think we're heading with these banks, these regional banks starting to fail. Anyways, hope you guys are doing great. Leave a comment. I'd appreciate it. You guys take care. I'll see you guys next time. See ya.